A corporation is an independent legal entity owned by its shareholders. This means that the corporation itself is legally liable for its actions and debts, not the shareholders who own it. Corporations are more complex than sole proprietorships, partnerships, and limited liability companies because they tend to have more administrative, tax, and legal responsibilities imposed on them. Because of this, corporations are generally better suited for more established and larger companies. Because it is a legally distinct entity, separate from its owners, a corporation is given many of the same legal rights as an actual person. But its owners don't have to risk their personal assets in the event the corporation can't satisfy its obligations. But it also means that corporations are usually taxed separately from its owners as well. You don't have to be a large company to be a corporation. In fact, in recent years, many small businesses have made the decision to incorporate to not only limit their personal liability and protect their personal assets, but also gain credibility, attract outside investment, and access more sophisticated tax planning strategies. A corporation comes into existence when prospective shareholders file a charter document with the state's Business Entities Department, which is usually the Secretary of State. The owners of a corporation are called shareholders, and shares of stock represent their ownership interests. A corporation must have at least one owner. There is usually no limit on the number of shareholders a corporation can have, but the most notable exception is being an S corporation that is limited to 100 shareholders. In the eyes of the IRS, there are two types of corporations: C corporations and S corporations. By default, all newly formed corporations begin as a C corporation and are taxed separately from their owners under Subchapter C of the Internal Revenue Code. They file a corporate tax return and pay taxes on their profits. When these profits are then distributed to the shareholders will pay taxes on the distribution. Certain corporations elect to be treated as an S corporation for federal tax purposes by filing Form 2553 with the IRS. This election causes the corporation to be treated as a pass-through entity. The corporation files an informational tax return but doesn't pay taxes at the corporate level. Rather, the profits and losses are passed through the business and reported on the shareholders' personal income tax returns. Electing S corporation status is one way of avoiding double taxation. Sometimes, at the state level, there are two types of corporations as well: regular and close. Up to now, I've been referring only to regular corporations. A close corporation is generally a smaller corporation that elects close corporation status and is entitled to operate without the strict formalities required in the operation of a regular corporation. Simply stated, it is a corporation whose shareholders and directors are allowed to operate more like a partnership because there are typically less than 30 shareholders. The close corporation election is made at the state level, but a number of states do not recognize them. Corporations have a set management structure. The shareholders elect a board of directors, who in turn elects officers. Other than the election of the directors, the shareholders usually don't participate in the operations of the corporation. The board of directors manages the corporation at a strategic level, issues stock, and makes major decisions. But it's the officers who are responsible for the day-to-day operation of the company. A corporation must follow various formalities to be recognized as a legally distinct entity. Failure to follow these formalities can have dire consequences, including holding the shareholders personally liable for corporate debts and actions. These formalities include the appointment of directors and officers, adopting bylaws and resolutions, holding formal meetings, and completing other compliance tasks that keep the corporation in good standing. So what are the advantages of forming a corporation? First and foremost is the limited liability protection that corporation status affords its shareholders. Although the shareholders may lose their investment in the corporation, their personal assets remain protected. Second is the relative ease in which a corporation can raise capital and attract talent. Investors can be lured with the prospect of capital gains if their stock appreciates, and dividends for when the corporation makes a profit. And finally, a corporation has perpetual duration. The corporation can continue as a separate and distinct legal entity, and its shares transferred from one owner to another indefinitely. It exists until the shareholders decide otherwise. And the disadvantages? First is the possibility of double taxation in the case of C corporations. Profits are taxed to the corporation when earned and then taxed to the shareholders when distributed as dividends. Second, corporations are highly regulated and often require attorneys and accountants to remain in compliance with the state and to navigate all the administrative complexities. Finally, there's just a lot of paperwork, bylaws, notices, waivers, annual reports, and multiple tax returns, not to mention regular annual meetings. And the list goes on.